good morning or good afternoon, Westminster Wealth Management people. I'm here, Kevin Lynch. I'm here presenting strategies to help you save taxes and get more out of your IRA, or for short, IRA Planning. And hope you get a lot out of this. We do these webinars every so often so people can understand a little bit more about their retirement lives. They're all obviously free of charge. I'll have contact information at the end if indeed you had, a specific question for your situation that you might want me to address, and I'd be happy to do that. So without further delay, we'll kick off. So here are some of the common questions that I get, certainly not an exhaustive list, but a great start. So can I still contribute? And if so, how much can I contribute to my IRA? Great question. We'll go through it. What type of IRA is right for me? So just by that very question, there's several varieties. When do I need to take withdrawals and how much? Well, the Secure Act recently changed that, and we call that Secure Act 1.0. There's legislation which is dubbed Secure Act 2.0, which may indeed change the rules yet again, but stay tuned on that. If that does indeed occur, I'll be shooting out a quick update on what the new rules are. How are my IRA withdrawals taxed? What happens when I die? How do the new laws affect me? We'll go through that. And then how can I minimize taxes? We'll talk a little bit about that as well. Okay, so it's jam-packed with information. So just stay with me, and if you're enjoying a glass of wine with it, that's great. So I hope you get a lot out of it. All right, well, firstly, I'd like to point out is that life's gotten complicated. So if you look at your accumulation phase, which is putting money in accounts, through 40 years, really 35, 40 years, you get to this apex here, and that's called retirement. And then you have this other phase that goes on, and that's called the distribution phase of your life. So years ago, pensions were quite numerous and common. That is not the case today. People don't have pensions. In fact, I saw a statistic, I think it was 12 years ago, 41% of companies offered a pension. And now today it's like 6%. So it's really become a dinosaur almost. Certainly Social Security benefits, people rely on those. And whatever else they've managed to save in brokerage or savings accounts. Companies have largely shifted away from pensions, and they've really put the onus on the consumer, so to speak, in a 401k plan. Because when we move from a defined benefit plan, which is a pension, to a defined contribution plan, everyone became money managers with no training. That's essentially what happened. Companies were like, okay, here you go. Oh, and by the way, we'll match some money, but you go invest this on your own, and good luck doing so. It really was, and I'm generous in what I say here in shifting, certain risks to employees. Essentially, all of your investing was shifted to you, and now it's your responsibility. So obviously, it increases the stress that people are feeling, especially when the markets take a hit and you're trying to retire, because your runway to make that loss up is now severely limited. You have to start using the money. So it's gotten really a lot more complicated for folks, and I have great empathy for it. I really do. One of the complications that's adding is how long people live. Now, this is a bigger concern than what a lot of people in their early 60s, mid 60s are giving credit for. If you're 65, okay, and you are a male, you have a 71% chance of living till 80. Females have a 79% chance of living till 80. And if you're a couple, you have basically a 94% chance of one of the two of you being alive at age 80. So it's really, and that's how you read the chart. So you look at age 90, my goodness, 1/3 of men have a chance, 32%. If you're age 65 today, 32% of you are going to live till 90. So what does that say for your retirement money? Well, you have to make it last. That's what it says. And this is, outliving your money is one of the big concerns that people share with me. So, and now you finally have a chance to save. So you may be mortgage free. You may have paid that last payment. Okay, terrific. You may be all done with those child education expenses. That's great. And then other expenses of raising a family. Certainly, the food consumption, if your kids have gone and left the house, has gone way down. So bills have gone way down. So it may be indeed the first time that you're really able to sock money away for your retirement. So come some basics about IRAs. Contributions may be tax deductible. The savings grow tax deferred while inside the account, and withdrawals are generally added to your income taxes. I have a footnote there, which I do want to point out. If you make withdrawals prior to age 59 and a half, okay, that's a magic number. If you make withdrawals from an IRA and you're younger than 59 and a half, not only do you pay income taxes on that withdrawal, but the IRS will also assess you a 10% penalty. So be aware of that. Be very careful not to pull money out before 59 and a half. So contribution rules for IRAs. Well, the maximum contribution you can do in 2022 is $6,000, $7,000 if you're over 50 by the end of the year. That $1,000 difference they call the catch-up contribution. So anyone can deposit, $6,000. Again, if you're over 50, you can put $7,000, and that number is yearly. Okay, that's the max you can do. I indicate it's the maximum contribution for 2022 because the 2023 contribution may be higher. They do tend to go up in what they allow people to contribute. In order to contribute, you have to have compensation, generally earned income. So think about, a W-2 or if you're a consultant, a 1099, that type of thing. Okay, so compensation. And then beginning for year 2020 and later, they passed, again, they changed some of the laws and they said that there's no age limit for making traditional IRA contributions. So you can make an IRA contribution into your 70s if you wish, as long as you have earned income. So traditional IRA rules, IRA contributions are deductible unless, so that should tell you something. Anybody can make an IRA contribution. The deal is it deductible from your taxes or not? Okay, so anyone can make a traditional IRA contribution. The question is it deductible? So the IRA contributions are deductible unless, and here's the two bullets. This is an and, by the way, not an or. You and or your spouse are active participants in an employer plan, okay? And your income exceeds an applicable threshold amount. All right, so those are the rules around contributions to traditional IRAs. Roth IRA Basics. Okay, I said there would be several types of IRAs we speak about. A traditional IRA is very different than a Roth IRA. So a Roth IRA, no deduction for contributions. So with a traditional IRA, if you put $6,000 in that account, it's as if your income for that year went down by $6,000 because you're deferring the tax payment on that $6,000. However, if you do a Roth IRA, that's an after-tax contribution of that $6,000 to an account that then grows tax deferred, and the dollars come out tax-free. Savings grow tax deferred. Contributions may be withdrawn at any time, tax and penalty free. Qualified distributions may include earnings that are also tax-free. You notice I've underlined the word qualified. Well, for the interest that an IRA makes, for that to come out tax-free, your Roth account has to be at least 5 years old. Okay, you contributing money in year 2 and 3 still counts towards the account being 5 years old. The clock does not start new with a new contribution, but you must have the account 5 years old. And it's only at that time that the interest that you make in the account, that those interest dollars can come out tax-free to you. Anything you've contributed yourself can come out tax-free at any time. You can do that. but I'm just sharing that the account has to be 5 years old. So make sure you kind of get that gestation period cared for. And I often tell people, if you don't have a Roth, you could open a Roth for $100, $250, and just get that clock ticking. That's what I often will tell clients and do it. Just full disclosure, all of my children have Roths. I made sure that they open Roth accounts early on to make sure we get the 5-year clock done. And there's nothing like growing tax deferred and dollars coming out tax free, especially if our kids are young and they have youth and longevity on their side. And that eighth wonder of the world called compounding interest. So that's a great thing. Okay, Roth IRA contribution rules. Very similar to a traditional IRA. So the maximum contribution in 2022 is $6,000. But again, if you're over age 50 or turning 50 in that year, you can put $7,000 in. That's that $1,000 catch-up. There is a catch-up contribution that is applicable to Roths as well. Again, you must have compensation. Okay, you have to have compensation. There's no age limit to contribute to a Roth. Income, though, cannot exceed certain levels. I always say anytime there are rules around how much you can put in, it must be a good thing. Not the rule, but the vehicle. So Roths are a good thing. And the fact that they have a limit on it tells you something, that they don't want too much going in there. So the rules around contribution limits deal with salary. So if you're a single filer and you make up to, you make below $129,000, you can contribute the full amount into a Roth. Married couples, okay, if you're filing jointly, that income number goes up to $204,000. So just be aware that there are income limits that would then prohibit you from contributing new dollars into a Roth. That's how that works. Spousal IRA, Roth IRA contributions. So if you work and your spouse doesn't, it allows the working spouse to make traditional or Roth IRA contributions for their non-working spouse. So non-working spouses meet all the other qualifications for applicable IRA. So the catch here, though, is that, and you have to remember this, that if you're contributing $6,000 per year, I'm assuming you're under 50, it's a max of $6,000. So you cannot contribute $6,000 to a traditional IRA and then $6,000 to a Roth IRA. It's $6,000 total. So you can contribute $3,000 to the traditional IRA and $3,000 to a Roth IRA, and then you're done. You can't contribute any more. Okay, so that's how that works. But so if your husband or if your wife is working, you're not, they can contribute to either a Roth IRA or a traditional IRA on your behalf, in addition to what they contribute for themselves. So